Hello people, welcome to my channel Trading with Ben K. In today's video we are going to talk about some of the ways that you should never trade and some of the factors you have to consider before you place a trade. So if this type of video interests you, I urge you to stick around for more details about this video. Now, when I was a beginner Forex trader, I had a very funny way of trading. What I basically do is that I trade based on candlestick. Now, when I say I trade based on candlestick, I'm not trying to say that I trade based on candlestick patterns. No, this is actually funny, but I'll tell you. Now, I'll pick a pair like the Euro USD. As you can see right here, we are on the Euro USD chart. Now, when I pick a pair like the Euro USD, I would go to the 1 hour time frame, just like this. I'm on the 1 hour time frame, and then I would make sure that I time the 6 a.m. GMT candle. All right, the 6 a.m. candle. Now, from where I live in this world, the London session opens at 7 a.m. GMT. So what I basically do is that I would use the 6 a.m. 1 hour candle like this, as I've highlighted on it like this, and then make my trading decision based on this candle. So what I mean is that if this candle is a bearish candle, as you can see here, I presume that the next candle that will open just on the London session open, which is on 7 a.m. GMT, it will also be bearish. So what I'll basically do is that I'll pick my short tool. This is a short position tool, and then just at the end or at the close of the candle right here, I will short it. I target around 20 pips. Alright, so I target around 20 pips. Okay, so right there, 20 pips. I put my stop loss just above these highs over here, and then I presume that when the London session opens, it will just run through and then make me some 20 pips. But let's see what happens when I do that. I'll click play. Exactly. So this obviously tells you how not to trade. Okay, so it's a very good example of how not to trade. So you can see that the next candle that came in at 0700 hours, that is 7 o'clock early in the morning, just a bullish candle that just went through my stop loss. It didn't even give you any gains when you place the trade. So it tells you that this is not a very good way of trading. Now, this type of trading made me some gains. For starters, will give you some few gains and all that. You might get it right at some points when you are trading it and all that, but most of the times it made me a lot of losses. So it tells you that this is not a very good way of trading because it's not based on any confluence. Now, somebody may ask me that why did this strategy fail? Now, this strategy failed because it is not based on any confluence. It is not based on any important trading decision factor. Now, these factors include market structure, key levels, and the like. Now, before you enter into a trade, now there are some key elements that you have to look out for. These elements include market structure, that is whether the market is in an uptrend or a downtrend or a consolidating market. You also have to look out for support and resistance. You also have to look out for trend lines. You can also use Fibonacci as a confluence in trading. So these are some of the important confluences that you can use when you are trading. It is very important. Just don't trade anyhow. Don't trade out of nowhere. It is not going to help you. So you have to make sure that you are placing your trade based on these confluences that I've mentioned. Okay, these are some of the confluences. I'm not saying that these are all the confluences that you need to make sure that your trade goes right. And the confluences that I've mentioned need not all come to fruition. or we don't need a confirmation from all these confluences. Probably two of them, can make a good trade. So now, based on the first element that I talked about, I said market structure, the structure of the entire market. It is very, very important when you are placing your trade. You always have to consider the market structure when you are placing your trade. Now, there are three kinds of markets, or there are three kinds of market structures that the chart will display at a given point in time. The particular pair will either be in an uptrend, which is depicted by the particular pair will be in an uptrend, the particular pair will be in an uptrend, which will be depicted by higher highs and higher lows, or the pair will be in a ranging or a consolidating market with equal highs and equal lows, or the particular pair will be in a downtrend with lower lows and lower highs. Now, the uptrend is also known as the bull market. It is known as the bull market because the bulls, or those who are buying, have an upper hand over those who are selling. So that is why the market is ranging upwards. Do you understand? So now, in this type of market, what you want to be doing is you want to be buying. You want to be buying in an uptrend. Okay, so that is what you want to be doing. Now, in the ranging market, now the strength of both the buyers and the sellers are equal. So nobody outmatches the other. So that is why it is called a ranging market. So it produces equal highs and equal lows. Now, in this type of market, I prefer to stay out until it starts trending again, because in this type of market it is not trending. All right, it is a non-trending market when it is ranging or consolidating. All right, so I would prefer to stay out. And in this market, which is the downtrend, the technical name is the bear market, because the sellers have an upper hand over the buyers, or the sellers are stronger than the buyers. So you can see the market trending downwards. So in this type of market, you want to be selling. That is what you want to be doing. So that is all for market structure. I'll do a proper detailed video about market structure in the future, so that I can address all the nitty-gritties about market structure that may confuse you. All right, so let's move on to an example. Now, to give you an example of market structure that I spoke about, let's look at GBP USD right here on the daily chart. I always observe my market structure on the daily time frame only. I only observe the market structure again on the daily time frame. I've done that for years and it has worked for me. I don't use a monthly time frame, I don't use a weekly time frame, although I will do an entire a top-down analysis, but I finally take my immediate structure from the daily time frame. All right, so I'm on the daily time frame currently as depicted here. So the question that I'll ask you is that what type of market it is. You can clearly see that the market is making higher highs and higher lows. All right, so there are so many buy points here, so it tells you that the market is in an uptrend. Yeah, right. So in this type of market, what do you want to be doing? You want to be buying. All right, so buy, because the market is going upwards. Now, don't forget that you can not only use market structure to trade. All right, you need additional confluences as well to make a trading decision. So this is part of the confluences for you to make a very good trading decision. Bear in mind. Okay, so the next confluence that I spoke about is support and resistance. Now, resistance is an area of the market where price begins to fall or bounce from. All right, where price fails to break through in an uptrend and then bounces from. Okay, so that is a resistance. Now, a support is a level where the market fails to break through and then there is a bounce upwards, okay, on the downside, right? So this impulse right here fails to break through this point, and then there's a bounce upwards. The same thing in regards to this one, it fails to break through at this point and there's a bounce upwards. Okay, so that is for support, but for resistance there is a bounce downwards. So these are the differences. I believe that you take note of these two. So this is a typical example of a trade involving the use of support and resistance as a confluence. So you can clearly see that when price got to this point, it fails to break upwards and then it bounces downwards. So this becomes a primary resistance. It got here the same way and then it did the same thing. Okay, so you can be looking for sells right here because this is a resistance. It failed to break through to the upside. Now on the opposite side also, it used the resistance right here at this level and then use it as a support. Okay, it got here and then it bounced upwards. So these are very good confluences for buy trades when it comes to support and then sell trades when it comes to resistance. Now trading out of nowhere is a very dangerous way to trade. For example, you may see this candle to be a bearish candle, all right, and you may be tempted to place a sell trade, but what happens subsequently? You can see the bullish rally upwards. If you have your stop loss somewhere around here, it will be taken. All right, so we don't trade out of nowhere, but it will not help you. So these are some of the confluences that you have to consider. So the next confluence that I spoke about, which is very important anytime that you want to place a trade, is the use of the trend line. Okay, so as depicted here. So how do we draw this trend line that I drew here? Let me delete it and then let's go to the left pin right here, and then you can see the trend tools on the second object right here. It has already been highlighted here, but I want to go further into details on how to select it. So the first one, trend line, you click on it, you can see that it has been highlighted. So once it has been highlighted, you start from the inception of the trend. Okay, I told you that I want to go further into detail into market structure later on in the videos, but for now, go with the flow. So in my case, this is the inception of the trend. Okay, so you make sure that you let it touch the wicks, okay, the wicks of the candles. Okay, so that is how you properly draw your trend lines. Okay, now these points on the trend line present a very good buying opportunity. All right, it's a buying opportunity because you're in an uptrend. I told you earlier on that in an uptrend, what you have to be looking for are buys. All right, so that is it for trend lines. Okay, it's a very major confluence for making a trading decision. Okay, so this is a very good example or a chart example of the trend line. So you can see that I started drawing my trend line from the inception of the trend using the last point of the wick. You can clearly see right here, again right here, point number 2, the last wick, and then usually the third touch of the trend line usually does the trick all the time. Now this is a very good way of trading. Once you get here, or once the candles come here, what you have to look for is to use the candlestick chart patterns that you name them, the morning star, the bullish engulfing, the maribozu, the bullish pin bar. These are all good confluences that you can use right there to analyze your trade and then make sure that you enter the trade. This is just more like an introductory video on to some of the concepts when it comes to the use of trend lines and actually trading. I'll go much more deeper into it in subsequent videos that I will make. So now I told you that the trend line third touch, or the third touch of the trend line, usually does the trick. I believe that you understand. Now, with the use of trend lines, another confluence that comes with it is the use of the Fibonacci. I don't want to go into details of what Fibonacci is, the founder of Fibonacci, and then what it means and the numbers involved and all that. I don't want this video to become a very long video, but I have the tool here in my favorite list. All right, future videos I'll show you how to create this list also, and then customize my trading view, or customize your trading view, I beg your pardon, according to the way that I've done it, and just as it is. So now, I told you that in trading the trend line strategy, it is very important to add the Fibonacci retracement. I have the Fibonacci retracement as part of my favorite tools, so that is why it is here. But if you want to look for it, I think yes, so we come to the third object on the left pane, and then you select the Fibonacci retracement. If you want to create, now let me tell you, if you want to create a favorite list just like I have here, you just have to click on the star to make it your favorite. Okay, once you start making it your favorite, it will appear here in the form of a box where you can select it easily anytime that you are doing your trading analysis. So now I've selected it already here to here. So now you click on it, and then you start from the second point on the trend line, and then you stretch it to the last part of the impulse, which is right here. This is the last part of the impulse, the wick. Use the wicks. All right, okay, so the inception of the trend always is the 100%. The last part of the rally becomes the 0%. So now it will start to retrace. All right, so that is why the tool is called the Fibonacci retracement. So it measures the level of retracement. If it retraces to half of the impulse, it becomes a 50% retracement. If it retraces to just about a quarter of the impulse, it becomes a 23.6 exactly, right? A 23.6 retracement. Okay, so now you can clearly see that it would never have a perfect touch. Okay, so this looks like a 61.8 retracement. Okay, if I use my replay tool, start new, just right there. Okay, so this is the replay tool trying to analyze the trade as to what happens. So you can clearly see that this is more like a morning star chart pattern right there, right, with a bearish candle, the small candle in between, and then a bullish candle. So that is a very good confirmation right there. So when I click on to start, okay, so let's see what happens. Okay, there is a small retracement downwards. Okay, all right, okay, so you can clearly see how our trade is playing out with the use of the Fibonacci retracement. Now, okay, so we are up into the trade. We click buy here, so we are up into the trade. Usually I take this level to be my take profit. Okay, so my take profit will be this high right here, or the last impulse high that he created here. That will be my take profit. Okay, sometimes when there are slight retracements within your trade, you don't have to panic. You just have to be very confident that it would hit your take profit, which it will eventually. You just have to have the patience to hold the trade, because if you're a beginner Forex trader, once it does this, probably you might be tempted to close the trade. but no, it is just trying to test your patience. Okay, I'm very much experienced to know this, so I will never panic in such a situation. All right, though I feel that eventually it, has hit our take profit, so we are very good to go. So that is the trade analysis involving the trend line and the Fibonacci retracement as well. People, I believe that you have really enjoyed this video. This video tells you that anytime that you want to place a trade, make sure that you know exactly what you are doing. You are not placing any trade anyhow. You are not just standing anywhere on the chart and then looking at the candles just like I used to trade when I was a beginner. If the previous 1 hour candle before the London Open is a bullish candle, then I'll place a buy trade, thinking that the market will go up. But that is a very wrong way of trading. Actually, you have to trade with the confluences that I've mentioned. Market structure, very, very, very important. Support and resistance, trend lines, as well as Fibonacci's. All right, so I believe that you have enjoyed this video. I'll be making more insightful trading content like this. Make sure that you subscribe to the channel and you like the video as well. Thank you very much for your time. I appreciate you guys a lot. All right, I'll see you another time.